Almost all indicators are derivatives of price. Some of them are based on volume. Now, volume is unique because it represents something totally different than the price. So when you're using ATR or Bollinger Bands or moving averages, they are using the price going up and down, but the volume is a separate entity. So the price can go up while the volume is going down or going up and vice versa. Now, I've done some videos using volume to analyze it and use it as a filter for the strategy. But the problem is the common knowledge out in the technical analysis space and in trader space, usually, of course, retail trading and YouTube. Usually they tell you that the volume has to go up while the trend is up, and the volume has to go down when the price is going down. Also, the volume needs to go up on a breakout and so on and so forth. All this is BS. I've tested all this. The only way that volume indicators can help you is using it as a strategy filter for other signals. So if you have some kind of signal, let's take a breakout, then you can use the volume aggregate as a filter. So you can use that when the average volume is going up or when the average volume is going down, or if the current volume is below average or above average. That usually it's a good filter. We can see here, this is the chart of the S&P 500 index using SPY, the ETF, and this is the volume. So green is when the bar is green, red is when the bar is red. That means this is buying pressure, this is selling pressure on the volume. So for example, this is a successful breakout, and you can see that the volume, first of all, is below average and it's just a normal volume bar. So there is nothing special about it. Here is another breakout, and again, the volume bar is very normal. And here is the price is going up, the volume is doing nothing. Price is going down, volume doing nothing. And then the price is doing nothing and the volume is spiking up for 7 days in a row. Now I can go on and on showing you different examples, but believe me, like I told you, I tested this many times. The single bar of volume doesn't make any difference unless you take it with the aggregate of the previous bars. Also, there is no sense in waiting for the volume to confirm a trend, because by the time you find that confirmation, the trend is done. As an algo trader, I think the best way to use volume as a strategy filter. And in today's video, I will show you a unique way how to use the volume as a strategy filter. Almost in all trading platforms, the volume indicator is colored green and red based on the closing price. So if the price current closing is higher than the previous close, then that volume bar will be green. And if the current close of this bar is below previous close, then the volume of this bar will be colored red. So green meaning there is buying pressure, and red meaning there is selling pressure. Of course, that does not reflect the reality. So let's take this example. Let's say I am buying 100 shares of the NASDAQ 100, and you are selling 100 shares of the NASDAQ 100. And let's say we get matched on the exchange. So what's that volume? Is it a buying pressure or a selling pressure? The way this is determined in futures and inside some platform is if you are buying at the ask, then that's buying pressure. And if you are selling at the bid, then that is selling pressure. So here is the depth of the market for the ES futures. So as you can see, this aggregate, the size, and what's the spread between the bid and the ask. So let's take this one. I am bidding to buy 30 contracts at 60.83. And then someone is willing to sell 34 contracts at 60.84.75. So I'm taking the third level because you can see this is changing all the time. So basically, this is the ask side and this is the bid side. So if I want to buy, instead of waiting for somebody here to come and fill me, I have to go here and fill my order immediately. So that means I am willing to pay a premium to buy this. That's why it is a buying pressure. Now on the opposite side, if I want to sell now, instead of waiting to sell at 60.84, and I don't know when that will hit, Probably it will not. Probably the price will keep going down. I need to go and sell immediately here. Fill this one. So I'm selling at the bid. So that's a selling pressure. So this is TradeStation. And in TradeStation, this is called uptick and downtick. So you can see this is the price. These are the candlesticks for the price. And if I click to show the data, you can see we have up volume and down volume. So the volume is split between up and down. And if we go to the definitions, so this is the stock symbols and this is the future symbols. So there is a big difference between the two. Intraday, we have upticks and downticks. So it's the same for futures, upticks and downticks. The upticks will measure the volume traded on the upticks, and the downticks will measure the volume traded on the downticks. That's the bid price. Now, this is the same for futures. The only difference is when we switch to the daily time frame, all volume is the same. But in futures, there is still a difference. The upticks calculate the volume today, and the downticks calculate the number of contracts that is still open and not closed. So this will be a little bit complicated if you're not a futures trader, but basically in futures, if I buy a contract, I have to close that contract before expiry. So there is an end to the contract that I'm buying. And if it's still open, that means I'm going to sell it at some point. Like I cannot hold it forever. So that's why it's considered a selling volume, because I have to sell this contract at some point. Now, regardless, we still have a distinction between our current volume and the open interest on the daily bar. So in TradeStation, this is the candlesticks and this is the normal volume bars. So basically when we have a close higher than the previous close, we will have a green volume bar. But like I told you, this does not represent the reality. So if I click here, this is a red candlestick and you can see that the up volume is 12,475. The down volume is 12,218. So the up volume is already greater than the down volume. Now, some astute traders will say, yes, I already know this because there is a long wick at the bottom here. But unfortunately, that is not true all the time. So look at this one. This is a green bar, but look at the upper wick. This is a huge wick. So we can assume that the selling volume here is more. But if I click on it, look at this. The up volume is 6,271, down volume 6,139. So the up volume is higher even though we have a huge wick. And let's look at this bar. This is clearly a buying pressure. And if I click on it, yes, we have 11,600 up and 10,200 down. But the one beside it, it looks the same. It's definitely a selling pressure. But look at the difference now. It's 49 to 6,900. So the percentage is much bigger. What I'm trying to say is you cannot tell from the candlestick which volume is more. Is it the buying volume or the selling volume? And yes, sometimes you can interpret the candlestick, but like I showed you, it's 50-50. It's a flip. Sometimes you are right and sometimes you will be wrong. Now, because this volume is split, I can put a separate indicator for it. So here, for example, this is only the up volume and this is the only down volume. And here in purple, this is the open interest. Now, this is only available for futures. Now, since we have these two separate, we can build any kind of indicator based on these two. And the indicator I built is we will sum all the up volume and we will sum all the down volume and we will deduct the down volume from the up volume to get some kind of oscillator. And at the bottom, this is the oscillator. So you see when it is above zero, that means the buying volume is more than the selling volume and it is in green. And when it is in red, that means the selling volume is higher than the buying volume and it is in red. Now, this is an average of 3 bars. So we are adding the 3 bars of the up volume, adding the 3 bars of the down volume, and then we deduct and we get this indicator. Now, really, I don't care how this works or which open interest is calculating what. I just need a different indicator to produce a unique filter. That's all I am interested in. This is not the best filter. This is not the best signal. It is just something else, something unique that I can use in my strategies to produce a different equity curve. And then I take that strategy with a different equity curve, combine it with other strategies in a portfolio, and trade that portfolio. So don't get bogged down by how this volume is calculated or what numbers are behind it. It's different than the volume indicator that we have inside our trading platform. So here we are in MultiCharts, and I have here the ES.D futures, and this is our new indicator. I call it KC net volume, KCNV. And basically when it's green, that means the volume is up, higher than the selling volume, and when it's red, it's the opposite. And this is taking the sum of the up volume minus the sum of the down volume over the last 3 bars. So you can see here it's 3. Now, of course, if I increase this, let's go to 21. Now it suddenly becomes like a market regime. And you can see it becomes a really good market regime. So maybe we don't know what's working and what's not. So we need to test it with a strategy that we definitely know the behavior of. Now, I've done many videos on the RSI2 strategy. There is one video in particular where I go really deep about all the values that you can use. And the most robust, stable RSI version is to buy the S&P 500 index when the RSI2 goes below 25, and to sell that position when the RSI2 go above 65. Usually on that strategy alone, I use another exit, which is the 5-bar exit. Here, I will not use the 5-bar exit just to test how good is this filter. So first of all, these are the results of the RSI strategy, 235,000 with 5.7 return to drawdown ratio and about 400 trades, 74% win rate, and about $580 on average. So we will test the look back of the KCNV indicator from 0 to 150. Now, 0 is just our original strategy. So we have something to compare with very easy. So let's do, it's 151 combinations, very easy. And 0 is our original strategy. This is the RSI2 strategy. Below 25, we go long. Above 65, we exit. There is no stop loss, no profit target, no bars exit. These are the results. Now, if I sort by return to drawdown, 3 is really good, followed by 2, 6, 5, 4. So it looks, it's all the low numbers, and then all the way 88 to about 100, which is very interesting. That means anything above 7 all the way to 80 is just not worth it. But here the difference is huge. Remember, 0 is our original strategy. So this is our original strategy. 5.69 is the return to drawdown, making $235,000. So we have 18 strategies that are doing much better with this filter. And actually the top strategy, which is very good, it's sitting between 2 and 1 and 4. It's making more money with lower drawdown, with higher average trade, with higher win percent, higher profit factor, and higher win-loss ratio. So it's higher in everything. Now, I should explain that the filter I'm using is when the indicator is below 0. And now we will do the same optimization, but now we are only going to allow the strategy to go long when the indicator is above 0. And if we sort by return to drawdown, 0, which is our original strategy, is the best strategy. And all the other values from 1 to 150 producing much worse results. And this is normally what you get when you are testing. Usually you will find something that is counterintuitive. In this case, we expect that when the indicator is green above 0, the RSI strategy will do better, but in fact it is not. The RSI strategy, it's on a pullback, and we need the sum of the volume of the down volume is higher than the sum of the up volume. That means there is a big selling pressure happening over the last 3 bars, and the price is going down, and then we go long, which just, this should be the start of a downtrend. But anyway, testing prove it's the opposite. Now I will test the same strategy, and we will use the same indicator as a filter on natural gas. Now, natural gas is the opposite of the S&P 500. It works really well with mean reversion shorting the instrument. So here is the natural gas futures, and again we have our indicator at the bottom. This is the original RSI strategy on the natural gas, which is when the RSI 2 above 75, we sell short. And when the RSI 2 go below 35, we cover our short. There's no stop loss, no profit target, and no fixed bar exit. The results of the strategy is total 400 trades, 72% win rate, $475 on average. Our return to drawdown, though, is very low. It's 2.8. Now, since we are flipping the RSI strategy, I will start with flipping the indicator, meaning we will allow the strategy to go short when the indicator is above 0, meaning it's green. Again, from 0 to 150, 0 is our original strategy. And 0 is our original strategy with 2.81. And if we sort by return to drawdown, we have about 5 strategies. So 5 strategies are doing better than the original strategy in terms of return to drawdown. So we reduce our drawdown, but also we reduce our profits. And again, the number is 3. So all the higher values produce worse results. Now we will test the strategy with the filter when it is below 0. So same as the S&P 500. This is our original strategy, 281. If we sort by return to drawdown, look at this huge difference. Again, here, testing prove us wrong. So you would expect that you need to flip the indicator when you're doing natural gas, because now we're going short, flipping the RSI, going short above 75. But yet it proves us wrong. It's still the same way. It is when the net volume is below 0, meaning there is selling pressure, then the strategy produces better results. And it's significantly better results. Remember, the original strategy is 2.8 return to drawdown, and this is 6.5. So it's almost a triple. Like, we have much lower drawdown. We are actually making more money with this one. But the only difference now we see, it's the values are higher. So this is more looking like a market regime. It's not like the ES. So although 63 is the most amount of money, but we can see 28, 29, 30, 31. All these are adjacent number, and they are producing good results. So let me pick 29, and let's see how that looks like. So this is 29, but let me show you how the indicator looks like with 29. It will look like a market regime, and as expected, you see, because we extended the look back period, and this is true for almost all indicators. When you extend the look back period, they become kind of like a market regime filter. And when you shorten the look back period, they behave as a signal. And we can see natural gas. So we're making 87 with 6.4 return to drawdown ratio, 348 trades with 540 average trade, and about 72% win rate. Now, since this indicator goes above 0 and below 0, I can easily switch it to something like MACD, where I put an average and a signal of the average and use the crossover. I can also use it with a stochastic to make it an oscillator that goes from 0 to 100. And probably I will do this in other videos. If you like this video, then you will love the next one.